2023 was a great rebound year from a challenging environment in 2022, and we finished the year quite strongly. As it relates to the full year from a sector allocation perspective, we were overweight information technology, and that was the largest positive contributor to our relative performance. We were also underweight areas like real estate and materials, which helped performance as well as those areas of the market struggled. From a stock selection perspective, we had strong contributions from selection within financials, communication services, as well as healthcare. Large and small caps equally struggled in 2022, and similarly, both rebounded in 2023. While we take a much longer view than these short-term periods of volatility, we are noticing that despite a positive year for both large and smalls, from a returns perspective, valuations remain very depressed. So none of the market activity came from multiple expansion. We've seen our businesses within the small cap space grow through earnings and meeting or exceeding expectations from the market. So while we don't necessarily have a view on large caps versus small caps, we would say that especially within the growth environment, both areas are depressed in terms of a valuation perspective, despite relative health of the companies. However, given that small caps have sold off much more aggressively than large caps in 2022, their valuations might look marginally more attractive than the large cap space. Portfolio maintains its consistent growth tilt, being overweight areas like healthcare and technology. We maintain exposure to some niche semiconductor players. We believe that that cycle is bottoming. It was under some pressure during the rate rising environment, but many of our businesses are pointing towards positive rebounds in 2024 and beyond. We continue to own industrial names in low-cost airlines and select airports, as well as digital job marketplaces. Within healthcare, we have select pharmaceutical businesses that will benefit from a rebound in the healthcare space, but also businesses that will benefit from the tailwind of a resurgence in biologics development as well. Our international small cap portfolio recently added Li Ning, which is a athletic wear business based in China, founded by legendary Olympic champion Mr. Li Ning himself. He won multiple medals in the 1984 Olympics. The business competes directly with juggernauts such as Adidas and Nike, and it had struggled coming through 2020 into 2022 as supply chain issues really messed with the merchants' ability to stock the shelves with Li Ning products. Those issues are largely behind us. The Chinese consumer looks like it is headed towards a soft landing, and so given the aggressive moves down in the stock, we took advantage of it from a valuation perspective. From a cultural perspective, it is truly led by Mr. Li Ning himself. The business currently has about a third of its market cap in cash, of which Mr. Li Ning has chosen to increase his stake in his own company, and the business has announced a share buyback. The company is very consistent and committed to being a Chinese-born brand sold in China. It's something we would call a domestic champion, and an area we think will benefit regardless of what's going on the geopolitical landscape. A second stock would be Saab. Many of us remember Saab as sort of a car company that put out more unreliable cars than reliable cars, but it's evolved over time to become a pure defense business. This is not only a business turnaround, but a cultural turnaround. They have a strong set of programs that they're selling into the defense industry. There's a chance of them being their country being included into NATO, and this reorganization that they've endeavored in to become a leading defense business is committing to leaner manufacturing and greater alignment with their customers.